The average ticker hound, or as he was once called, the tapeworm, often goes wrong not from a lack of intelligence but from over-specialization. He becomes a master of the minutiae, a scholar of the fractional movements, yet this very expertise fosters a highly expensive inelasticity. The game of speculation is not, after all, a rigid science of mathematics and set rules. Even within the precise art of tape reading, there exists an element that transcends mere arithmetic. It is the behavior of a stock, a distinct personality that reveals itself through actions, enabling a skilled operator to judge whether it will proceed according to the precedents his observations have noted. When a stock doesn't act right, the professional's rule is simple: don't touch it. Being unable to precisely diagnose what is wrong makes it impossible to know which way it is going. No diagnosis, no prognosis, no prognosis, no profit. This practice of noting a stock's behavior and studying its past performances is as old as the markets themselves. In the early days of Wall Street, you could find men who dedicated themselves to this art. There was a broker's office where a Frenchman would hold court, speaking of his charts and curves. At first he seemed like a pet freak, kept by the firm for amusement, but soon it became clear he was a persuasive and impressive talker. He preached that the only thing that could not lie was mathematics. Through his intricate charts, he claimed he could forecast market movements, analyzing past campaigns with uncanny precision, explaining why a great operator like Keene succeeded in one manipulation but failed in another. At times, professional traders would try the Frenchman's system, but they always returned to their old, unscientific methods. Their hit-or-miss approach, they claimed, was cheaper. Even Keene himself was said to have admitted the chart was 100% right, but far too slow for practical use in the heat of an active market. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. For those who are committed to this journey of knowledge, who return to these lessons to sharpen their minds after the inevitable setbacks of the market, your support is the fuel that keeps this channel going. In other offices, charts of daily price movements were kept, showing at a glance what each stock had done for months. Customers used them as a kind of complimentary tipster, comparing individual curves against the general market to see if a whispered recommendation was justified. Today, this is commonplace. Scores of commission houses offer ready-made charts from statistical experts, covering not just stocks but all commodities. But a chart is only a tool. It helps those who can assimilate what they read. But the average chart reader is prone to obsession. He sees the dips and peaks, the primary and secondary movements, and believes this is the entirety of speculation. If he pushes that confidence to its logical conclusion, he is bound to go broke. There was once an extremely able man, a trained mathematician from a famous technical school, who devised charts based on a minute study of price behavior across all markets: stocks, bonds, grain, cotton, money. He went back decades, tracing correlations and seasonal movements with scientific rigor. He used these charts in his trading for years, taking advantage of a highly intelligent form of averaging, and he won regularly. He and his large following built fortunes on this system, until the First World War knocked all historical precedents into a cocked hat. He lost millions before he finally desisted. This illustrates a profound truth. Not even a world war can stop a bull market when conditions are bullish, or a bear market when conditions are bearish. And the ultimate key to making money is simply to appraise those underlying conditions correctly. These early lessons, learned through the mistakes of ignorance, are the very same mistakes that the average stock speculator makes, year in and year out. Upon his third attempt to conquer the market in a legitimate stock exchange house, the young operator traded with vigor. He no longer expected the swift, easy profits of the bucket shops, but he believed that in time he would do much better by swinging a much heavier line of stock. Looking back, he could see his main trouble was a failure to grasp the vital difference between stock gambling and stock speculation. Yet with 7 years of tape-reading experience and a natural aptitude for the game, his stake was earning a very high rate of interest. He won and he lost, but on balance, he was winning. The more he made, the more he spent, a common experience for any human being not enslaved by the hoarding instinct. The game of beating the market was his exclusive focus from 10 in the morning until 3 in the afternoon. After that, his focus shifted to the game of living his life. He never allowed pleasure to interfere with business. His losses stemmed from being wrong, never from dissipation or excess. Shattered nerves or rum-shaken limbs never spoiled his game, for he couldn't afford anything that kept him from being physically and mentally fit. He maintained a disciplined life, often in bed by 10 because he knew he could not conduct business properly on insufficient sleep. He was doing better than breaking even, so he saw no need to deprive himself of the good things in life. The market, he felt, was always there to supply them. He was acquiring the cool, dispassionate confidence that comes to a man who has mastered his method of providing for himself. This new environment forced the first major change in his play, the element of time. He could no longer wait for a sure thing to come along and scalp a point or two as he did in the bucket shops. To catch the real move, he had to start much earlier. He had to study what was going to happen, to anticipate stock movements. This shift in attitude was of supreme importance. It taught him, little by little, the essential difference between betting on minor fluctuations and anticipating inevitable advances and declines, the difference between gambling and true speculation. He had to look further back than an hour in his studies, a perspective he never would have learned in the biggest bucket shop in the world. He immersed himself in trade reports, railroad earnings, and financial and commercial statistics. They still called him the boy plunger because he loved to trade heavily, but he also developed a love for studying the moves. Nothing was irksome if it helped him trade more intelligently. He adopted a core principle. Before he could solve a problem, he had to state it to himself. When he believed he had found the solution, he had to prove he was right. And he knew of only one way to prove it: with his own money. His progress, slow as it seemed, was as fast as it could be, considering he was making money on balance. Had he lost more often, perhaps it would have spurred him to more continuous study. But if he had lost more, he would have lacked the capital to test the improvements in his methods. It was in studying his winning plays that he made a startling discovery. Although he was often 100% right on the market, in his diagnosis of conditions and the general trend, he was not making as much money as his market rightness entitled him to. Why? The paradox plagued him. He came to realize there was as much to learn from a partial victory as there was from a complete defeat. For instance, he would be bullish from the very start of a bull market and back his opinion by buying stocks. An advance would follow, just as he had foreseen. So far, so good. But then he would listen to the elder statesman in the brokerage office and curb his youthful impetuousness. He would decide to be wise, to play carefully and conservatively. And everybody knew the way to do that was to take profits and buy back on reactions. That is precisely what he tried to do. But he often took his profits and waited for a reaction that never came. He would watch his stock soar another 10 points while he sat there, clutching his 4-point profit in his conservative pocket. It's true, they say you never grow poor taking profits. No, you don't. But you also don't grow rich taking a 4-point profit in a great bull market, where he should have made $20,000. He made $2,000. That was the price of his newfound conservatism. About the time he discovered what a small percentage of his potential earnings he was capturing, he made another observation about the nature of the players in the great game. Suckers, he realized, differ among themselves according to their degree of experience. The tyro knows nothing, and everyone, including himself, is aware of it. But the second-grade sucker believes he knows a great deal and makes others feel that way too. He is the experienced amateur who has studied not the market itself, but a few remarks about the market made by a still higher grade of suckers. He knows how to avoid some of the traps that catch the raw beginner. It is this semi-sucker, not the complete novice, who provides the year-round support for the commission houses. He lasts on average about 3.5 years, compared to the few weeks or months of the first offender. It is this semi-sucker who is always quoting the famous trading aphorisms, who knows all the don'ts from the lips of the old stagers, except the most important one: don't be a sucker. This is the type who thinks he has cut his wisdom teeth because he loves to buy on declines. He measures his bargains by the number of points a stock is sold off from its top. In a roaring bull market, the pure, unadulterated novice buys blindly because he hopes blindly and often makes the most money, until a healthy reaction takes it all away in a single, brutal swoop. But the careful Mike sucker does exactly what the young operator was doing when he thought he was playing the game intelligently, according to the intelligence of others. He knew he needed to change his bucket shop methods, and he thought any change, particularly one endorsed by the experienced traders around him, was the solution. Most customers, he found, were alike. In the brokerage office, there was the usual crowd, representing all grades of experience. But there was one old man who was different. His name was Partridge, but they nicknamed him Turkey behind his back because of his thick chest and his habit of strutting about with his chin resting on his breast. He was much older. He never volunteered advice, and he never bragged of his winnings. He was a great listener. He never seemed keen to get tips, but when someone gave him one, he would thank them politely. If the tip turned out well, he might thank them again. If it went wrong, he never whined. No one could tell if he acted on the advice or not. It was a legend in the office that he was rich and could swing a large line of stock, but his commissions were negligible. The other customers, always eager to have someone else to blame for their failures, would often approach old Partridge. They would tell him what a friend of an insider had advised, and then ask him what they ought to do. But whether the tip was to buy or to sell, the old man's answer was always the same. After the customer finished his tale of perplexity and asked, "What do you think I ought to do?" Old Turkey would cock his head, smile paternally, and say with great gravitas, "You know it's a bull market." Time and again the young operator heard him say it, as if he were handing over a priceless talisman wrapped in $1 million insurance policy. And for a long time the meaning was completely lost on him. One day a fellow named Elmer Harwood rushed into the office, sold his position in Climax Motors, and hurried over to Partridge. "Mr. Partridge," he declared, "I have just sold my Climax Motors. My people say the market is entitled to a reaction, and I'll be able to buy it back cheaper. So you'd better do likewise, if you've still got yours." Elmer had given Partridge the original tip, and now looked at him with the suspicion of a gratuitous tipster who feels he owns the soul of his beneficiary. "Yes, Mr. Harwood, I still have it." "Of course," Turkey replied gratefully. "Well, now is the time to take your profit and get in again on the next dip," Elmer insisted. Seeing no enthusiastic gratitude, he pressed on. "I have just sold every share I owned." But Mr. Partridge shook his head regretfully. No, I can't do that." "What?" yelled Elmer. "I simply can't," Partridge said, as if in great trouble. "Didn't I give you the tip to buy it? And didn't that stock go up 7 points in 10 days? "It did, and I am much obliged to you, my dear boy." "But I couldn't think of selling that stock." "You couldn't?" Elmer asked, a flicker of doubt crossing his own face. "Why not?" he pressed, drawing nearer. Old Turkey leaned in and delivered his explanation as if it were the most profound secret in the world. "Why, this is a bull market." Elmer, now angry with disappointment, shot back, "I know this is a bull market as well as you do. But you'd better sell that stock and buy it back on the reaction. You might as well reduce your cost." But old Partridge replied with great distress, "My dear boy, if I sold that stock now, I'd lose my position, and then where would I be?" Elmer threw up his hands and walked away in a daze. He couldn't comprehend the old man's logic. He says that if he sells, he'll lose his job, Elmer whispered in disbelief. Partridge overheard and corrected him. I beg your pardon, Mr. Harwood. I didn't say I'd lose my job. I said I'd lose my position. And when you are as old as I am, and you've been through as many booms and panics as I have, you'll know that to lose your position is something nobody can afford, not even John D. Rockefeller. I myself can only trade in accordance with the experience of many years. I paid a high price for it, and I don't feel like throwing away a second tuition fee. But I am as much obliged to you as if I had the money in the bank. It's a bull market, you know. And with that, he strutted away. What old Mr. Partridge said did not mean much to the young speculator until he began to reflect on his own numerous failures to make the money he ought to have made when he was so right on the general market. The more he studied, the more he realized the profound wisdom in the old man's simple words. Partridge had evidently suffered from the same defect in his youth and understood his own human weaknesses. He refused to lay himself open to a temptation that experience had taught him was hard to resist and had always proven expensive. It was a long step forward in the operator's education when he finally understood that when old Partridge kept repeating, "Well, you know this is a bull market," he was trying to convey that the big money was not in the individual fluctuations but in the main movements. The secret was not in reading the tape, but in sizing up the entire market and its trend. Understanding the journey of the man who discovered these principles is key to grasping their true weight. The psychological battles he fought, the millions he made and lost, and the ultimate price he paid for his genius are not just stories. They are the crucible in which this wisdom was forged. On our second channel, Trading Insights, we have released a comprehensive documentary, The Complete Story of Jesse Livermore, an exploration of over an hour into his life from his first $5 trade to his rise as a Wall Street titan and his tragic end. To truly comprehend the man behind the methods, we highly recommend you watch it. The link is in the description below. And here lies one of the most vital principles of speculation. After spending years in Wall Street and after making and losing millions of dollars, the great operator came to one conclusion. It never was his thinking that made the big money for him. It was always his sitting tight. It is no trick at all to be right on the market. You will always find early bulls in bull markets and early bears in bear markets. He had known many men who were right at exactly the right time, who began buying or selling at the very level that should have shown the greatest profit. And their experience invariably matched his own. They made no real money out of it. Men who can both be right and sit tight are uncommon. He found it one of the hardest things to learn. But it is only after a stock operator has firmly grasped this that he can make big money. It is literally true that millions come easier to a trader after he knows how to trade than hundreds did in the days of his ignorance. The reason is simple. A man may see straight and clearly and yet become impatient or doubtful when the market takes its time to do what he figured it must do. That is why so many men in Wall Street who are not at all in the sucker class nevertheless lose money. The market does not beat them. They beat themselves. Because though they have brains, they cannot sit tight. Old Turkey was dead right. He had not only the courage of his convictions, but the intelligent patience to sit tight. Disregarding the big swing and trying to jump in and out was fatal. Nobody can catch all the fluctuations. In a bull market, the game is to buy and hold until you believe that the bull market is near its end. To do this, you must study general conditions, not tips or special factors affecting individual stocks. Then, get out of all your stocks and get out for keeps. Wait until you see the turn of the market, the beginning of a reversal of general conditions. This requires brains and vision. It is not as simple as buy cheap and sell dear. One of the most helpful lessons any man can learn is to give up trying to catch the first eighth or the last eighth. These two are the most expensive eighths in the world. They have cost stock traders, in the aggregate, enough millions of dollars to build a concrete highway across the continent. Another thing he noticed was that his initial operations seldom showed him a loss. This taught him to start big, to have confidence in his own judgment before it could be vitiated by the advice of others or his own impatience. Without faith in his own judgment, no man can go very far in this game. This was the core of what he learned: to study general conditions, to take a position, and to stick to it. He learned to wait without a twinge of impatience, to see a setback without being shaken, knowing it is only temporary. He could be short 100,000 shares, see a rally coming that he knew would wipe out $1 million in paper profits, and still stand pat, without once considering covering his shorts only to put them out again. He knew that if he did, he might lose his position and with it, the certainty of a big killing. It is the big swing that makes the big money for you. He learned all this slowly because he learned from his mistakes. And time always elapses between making a mistake, realizing it, and finally determining its exact cause. But all the while he was faring comfortably. He was young. His winnings were still made in part through his tape reading, as the markets lent themselves well to his old method. But being broke multiple times in just a few years proved to be a very efficient educational agency. He was not increasing his stake very fast because he lived up to the handle, not depriving himself of the things a young man with money would want. He could not see the sense in skimping when he was taking it out of the market. Every time he found the reason for a loss, he added a brand new don't to his schedule of assets. The only incidents that remained etched in his memory were those that taught him something of definite value, something that added to his store of knowledge of the game and of himself. To truly learn from a master's mistakes without paying the $1 million tuition fees yourself, there is no greater tool than immersing yourself in his story. Edwin Lefebvre's timeless masterpiece, Reminiscences of a Stock Operator, is more than a book. It is the closest thing a speculator can get to a flight simulator for the human mind. The wisdom you have just heard, the painful and expensive lessons on the difference between gambling and speculating, the vital importance of sitting tight, were all drawn directly from Chapter 5 of this incredible work. In its pages, you do not just read about Jesse Livermore's triumphs and disasters, you live them. You feel the gut-wrenching pain of his greatest blunders and the quiet, profound satisfaction of his most brilliant campaigns. For those truly committed to this deep study, we highly recommend the edition which includes a unique, detailed chapter-by-chapter analysis by Max Davidson. This analysis acts as your co-pilot, translating the century-old wisdom of the text into a clear, actionable roadmap for the modern trader, ensuring that the lessons learned in 1923 are as powerful and as profitable today as they were then. A link to this essential edition is provided in the description below.